Welcome to the Startup Funding Espresso. I'm Halti Martin, the host of this show where we talk about raising funding for your startup and the time it takes to have an espresso. I hope you enjoy this episode. Hello, this is Halti Martin with the Startup Funding Espresso, your daily shot of startup funding and investing. Depreciation represents the reduced value of assets. Each asset in your business has its own useful lifetime. Based on that useful lifetime, one can expense a portion of the value each year over the life of that asset. Depreciation goes on the profit and loss statement and also impacts the value of the asset listed on the balance sheet. Computers, for example, are often depreciated over a 4-year time frame. If you spent $16,000 on computers in the last 4 years, then a straight line depreciation will expense $4,000 per year. You'll need to set up a separate worksheet for each asset to calculate and track the depreciation. You then place the expense on the profit and loss statement and show the reduced value of the asset on the balance sheet. Based on the type of asset, you may be able to use other depreciation methods aside from straight line depreciation. You'll need to check the IRS rules for each asset as they have stated requirements for how you depreciate each one. Thank you for joining us for the Startup Funding Espresso, where we help startups and investors connect for funding. Let's go start up something today. Halti Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinions of Investor Connect. This podcast is for informational purposes only and should not be relied upon for the basis of investment decisions.